When I think of Texas Instruments, what comes to mind is the graphing calculators they forced you to use in school. That doesn't scream great investment. However, don't let that perception influence your thoughts on the company. Texas Instruments is far larger, designing and manufacturing chips used throughout our modern economy. The company is an economic powerhouse with a long-term mindset. All you need to do is take a look at their investor relations page. At first sight, it seems to align perfectly with what I look for in a long-term investment. Rich Templeton, the chairman, president, and CEO of Texas Instruments, says the best measure to judge a company's performance over time is growth of free cash flow per share, and we believe that's what drives long-term value for our owners. For many years, we've run our business with three overarching ambitions in mind. We will act like owners who will own the company for decades. We will adapt and succeed in a world that's ever-changing, and we will be a company that we're personally proud to be a part of and would want as our neighbor. This is exactly what I want from a long-term dividend growth stock. Their recent history backs it up too. From 2004 to 2021, they've had 12% annual growth in free cash flow per share. Also, 18 consecutive years of dividend increases with a 25% compound annual growth rate. On top of this, they've consistently bought back shares with a 46% reduction in share count. This is great financial performance, so naturally, I'm quite intrigued to learn more. In this video, I'm going to provide a comprehensive overview of Texas Instruments' business and explain why I think it's a great value to add to your long-term dividend stock portfolio. My name is Zach, and you should leave a like and subscribe to the channel if you enjoyed the video. You should only invest in businesses you fully understand, so today I'm going to provide a full picture look at Texas Instruments stock. First, let's recap the company's history.
Companies like TI have been engineering progress for decades. The vacuum tube was once at the heart of all electronics. For the first time, entertainment and information could be transmitted and received in real time. In 1954, TI engineer Gordon Teal introduced the world's first commercial silicon transistor. Electronics became personal and could be held in your hand, and things never before imagined were possible. 4 years later, in 1958, TI engineer Jack Kilby combined multiple transistors onto a single piece of semiconducting material to create the world's first integrated circuit. The chip that Jack built changed the world forever. Radar systems were made more reliable. Spacecraft were built with smaller, lighter, more dependable components. Computing power that once cost millions became more powerful, affordable, and could fit in your pocket. Through decades of progress, our innovations continued to make electronics more accessible to more people. And today, semiconductors are so affordable that they're being added to everything.
Texas Instruments is one of the most influential companies in the history of semiconductors. If you watched my Intel stock review video, you may remember that I mentioned Intel co-founder Robert Noyce was credited with inventing the integrated circuit. Well, the interesting thing was that Noyce and TI's Jack Kilby both independently invented it months apart from one another. But enough history. What does TI's business look like today? They have over 30,000 employees and 15 manufacturing sites worldwide. This produces tens of billions of chips each year. In 2021, Texas Instruments generated $18.34 billion in revenue. 77% of this comes from their analog chip business, 17% from embedded chips, and 6% from other. Other includes their DLP and calculator business. By end market, 41% of TI revenue comes from industrial, 21% automotive, 24% personal electronics, 6% communication equipment, 6% enterprise systems, and 2% other. The company places its greatest strategic emphasis on industrial and automotive. They argue their industrial and automotive customers are increasingly turning to analog and embedded technology to make their products smarter, safer, more connected, and more efficient. Examples in industrial include smart motors to conserve energy in factories, robotic assembly lines using sensing technology, and sensors in tanks to gauge fluid levels. Examples in automotive include infotainment consoles, advanced driver assistance systems, hybrid and electric powertrain systems, and body electronics and lighting. They expect these trends to continue and lead to faster growth compared to other markets. Let's dive a little deeper. What exactly is the difference between analog and embedded chips? A better way to define this is analog versus digital. Digital chips are the binary logic you typically think of with computers, while analog chips process physical functions such as temperature, speed, sound, electrical current, etc. Since digital chips were the brains of the personal computer revolution, they're typically thought of as the sexier investment in the semiconductor industry. However, it's often overlooked that analog chips are just as growing of an opportunity. Every electronic product requires analog technology because analog provides the power to run devices. So every time a system is digitized, there is need for analog chips. Texas Instruments' analog business includes power and signal chain types of products. Power products help customers manage different voltage and current levels in electronic systems. Their portfolio does this for both battery-powered and plugged-in systems. Signal chain products sense, condition, and measure real-world signals to allow information to be transferred or converted for farther processing and control. The company has a dominant market position in analog chips. As of 2020, they control 19% of the analog market share. This is more than double that of runner-up analog devices. So why is this? Let's hear from Texas Instruments themselves about what their competitive advantages are.
TI's business model is built on 4 competitive advantages. In combination, these advantages provide tangible benefits, are difficult to replicate, and ultimately separate us from our best peers. Our manufacturing and technology competitive advantage results in lower manufacturing costs and greater control of our supply chain. A chip built on our 300mm wafers costs about 40% less than a chip built on 200mm wafers, the size used by most of our competitors. We also perform the majority of assembly and testing internally, which gives us additional cost advantages and greater control of our supply chain. Our second competitive advantage is the breadth of our product portfolio. Most customers' applications use tens, if not hundreds, of chips in each system. Our breadth of product portfolio gives us access to more customers because there is high probability a customer will visit TI.com while designing their system. It also means that we have the opportunity to sell more chips into each customer application. Each year, we expand our portfolio and ensure long-term return on investment, given that many of our products can live for 10 to 20 years or longer. Our third competitive advantage is the reach of our market channels, referring to our online presence through TI.com and our global sales and applications team. We have tens of millions of visits to TI.com annually. And because of our broad portfolio and revenue, we're able to invest in a global sales and applications team that's bigger than our competition. We work to make TI the most convenient place for our customers to search, select, design, ramp to production, and eventually purchase their chips. This advantage means we have access to more customers and design projects, leading to the opportunity to sell more of our products. Additionally, broader and deeper access gives us better insight and knowledge of customer needs. Lastly, we have diverse and long-lived positions with our products, markets, and customers. Diversity means we're not overly reliant on any one chip, customer, or market. Longevity means the investments we make in manufacturing equipment and process technologies, which are typically used for 20 years and more, make our business less capital intensive. Longevity also means the revenue associated with products and customer design sockets we win typically lives for a long period of time, from several years to several decades. Our owners can have confidence in the high terminal value for our portfolio.
TI's competitive advantages are only getting stronger. They're increasing their market-leading manufacturing at a faster rate than their competition. TI's third 300mm wafer fab is under construction and will have a production output in the second half of 2022. Their fourth 300mm wafer fab was purchased and will have production output in early 2023. They announced their fifth to eighth 300mm wafer fabs, which are expected to reach production in 2025. Aside from the manufacturing advantage, they have a broader product portfolio and a more direct relationship with customers. They've invested in a sales team and TI.com, resulting in 64% of their 2021 revenue being direct. This is up from 35% in 2019. TI.com has dramatically improved, resulting in 10% of 2021 revenue. This gives them a direct relationship with customers and increases the likelihood they will stay in their product ecosystem. Texas Instruments has a dominant market position and is a free cash flow machine. Before I dive into TXN stock's financials, let's hear from the company about their strategy on capital allocation.
An important element of our strategy to maximize free cash flow per share growth is disciplined allocation of capital to the best opportunities. This spans how we select R&D projects, develop new capabilities like TI.com, invest in new manufacturing capacity, or how we think about acquisitions and returning cash to owners. Given the magnitude of our capital allocation, you can quickly appreciate why capital allocation is a job we take seriously and one that has significant impact on owner returns. Our largest category of capital allocation is investment in critical areas that drive organic growth, such as R&D, sales and marketing, capital expenditures, and working capital for inventory. We are pleased with the results of our investments in R&D that strengthen both our manufacturing process technology as well as our product portfolio. The second largest category is share repurchases. Here, our objective is the accretive capture of future free cash flow for long-term owners. We focus on consistent repurchases when the present stock price is below the intrinsic value, using reasonable growth assumptions. Next is dividends, where our objective is to appeal to a broader set of investors, and we focus on their sustainability and growth for obvious reasons. And finally, potential acquisitions are evaluated through two primary factors that have remained unchanged. It must be a strategic match, meaning catalog analog focus, with high exposure to industrial and automotive. Additionally, it must meet certain financial metrics, such as generating a return greater than our weighted average cost of capital within about 4 years. From an R&D standpoint, investments are allocated to higher value growth opportunities in order to strengthen our technology and product portfolio, while improving diversity and longevity. Our focus is on the best products in the semiconductor industry, analog and embedded processing, with a strategic emphasis on the best markets, industrial and automotive. As shown here, we sell our chips into 6 end markets. We see good opportunities in all of our markets, but as I mentioned, we place additional strategic emphasis on industrial and automotive. Our industrial and automotive customers are increasingly turning to analog and embedded technology to make their end products smarter, safer, more connected, and more efficient. These trends have and will continue to result in growing chip content per application, which will drive faster growth compared to our other markets. The industrial and automotive markets have high diversity, meaning many customers, many sectors, and many equipment types. These markets also have high longevity, where they tend to have life cycles ranging from several years to several decades. Success in industrial and automotive, therefore, requires a long-term commitment and a willingness to invest broadly across sectors and product categories, both of which we have done and continue to do. As you can see, we apply a very disciplined approach to capital allocation to ensure our investments are going to the best opportunities, strengthening our competitive advantages, and generating the maximum return for owners.
Texas Instruments may be one of the most disciplined and financially well-run companies I've analyzed. Let's take a deep dive into its financial metrics. To do so, I'm going to be using my own research software at dividenddata.com. You can join the free beta test period, which is available to the public now. We can see the company is currently valued at $152 billion with 923 million shares outstanding, giving it a current price per share of $164.65. We can see the non-GAAP earnings per share have been consistently growing, especially in recent years. If we look at the revenue, you can see its revenue per share is growing at a 5% 10-year compound annual growth rate. In recent years, it's been growing at a faster rate. However, net income and free cash flow is where Texas Instruments shines. Net income per share is growing at a 15.79% 10-year compound annual growth rate. Over the last 5 years, it's growing at an 18.45% compound annual growth rate. The free cash flow per share is growing at a 12.39% 10-year compound annual growth rate. Free cash flow is growing at a slightly lower rate than net income since they've been having larger capital expenditures. TI has been investing in new manufacturing capabilities, as we discussed earlier. Margins are very high, especially during the recent semiconductor shortage. There's large demand and limited supply, which allows TI to utilize its dominant position for pricing power to increase margins. On an annual basis, they posted a 67% gross margin and a 42% net margin in 2021. Margins have been steadily growing over the past decade, and I expect they will remain reasonably high. The semiconductor shortage is ongoing. However, with all the new fab construction, supply will increase over the next few years. They have solid shareholder equity, and their debt is reasonable. Also, Texas Instruments management is incredibly shareholder friendly. They've been reliably buying back stock at a high rate. As I mentioned earlier, from 2004 to 2021, they've had a 46% reduction in share count. This means that the relative value of each share is increasing. So as a shareholder, your ownership in the company is increasing without you doing anything. In addition to these buybacks, TI pays a high growing dividend. They've been raising their dividend for 18 consecutive years. Over the last 10 years, the compound annual growth rate of the dividend is 21%. Over the last 5 years, it's 18%. And over the last 3 years, it's 14%. They just had a 12.75% increase. The current dividend yield is 2.7%, which is historically a high entry point. The 2021 payout ratio is 50% of net income and 62% of free cash flow. Given the company's financial growth, I would expect 10% annual dividend increases for the near future. This is a great long-term dividend growth stock. All of Texas Instruments' financials look positive. Also, the company is trading at an attractive valuation. Its PE is 19 over the trailing 12 months, and the company is down nearly 20% from its high. Considering the company's growth rate, this seems like an attractive buying opportunity. I currently don't own any TXN stock, but will be looking to add it to my long-term dividend stock portfolio. However, don't take my advice blindly, and be sure to do your own research before making any investment decisions. Thank you for watching Dividend Data. I'd greatly appreciate if you could leave a like and subscribe to the channel. If you follow me on Twitter, link in the description, you can get real-time updates of my buys and dividends coming in. Check out dividenddata.com for my dividend investing software. You can support the channel over on Patreon, where you can gain access to a community Discord server. The link is in the description. Please leave a comment below, and thank you for watching.